Hi, I'm Jimmy. In this video, I'm hoping to clear up a few questions about how to come up with a fair value for a stock, particularly using discounted free cash flow. And I actually want to let you know about a new Learn to Invest channel that I'm launching. Okay, so I'm launching a second Learn to Invest channel called Learn to Invest Shorts. And as you might have guessed, that's where I'm going to put all of our short videos. Now, these are videos that have to be less than 60 seconds long to qualify as a YouTube short. And I've done a few of these videos in the past on this channel, and overall they seem to be fairly well received. Generally, I've been doing quick company overviews, mostly after a company comes out with earnings, or big news events. So I'll do maybe the first 20 or 30 seconds on the earnings, what happened with earnings, and then the final 20 or 30 seconds talking about what fair value we came up with for that particular stock using the new updated earnings projections. Now, generally, I prefer to use discounted free cash flow, but that only works with companies that have positive free cash flow. So if they don't, we generally use a different method. So the goal with this new channel is to either hit on a piece of news or perhaps some investing concept that you can explain really, really quickly that I get asked about a lot, and to give quick ideas when looking at companies, do a quick analysis, mostly revolving around coming up with a fair value for that company. So I'll leave a link to this new channel in the description below. And it's, like I said, it's called Learn to Invest Shorts. So if possible, please head over to that channel. And we just recently published the first video over on that channel where I did a quick valuation of Disney stock after their most recent earnings update. So if you can, go over to that channel, watch that video, subscribe, let me know what you think of the videos and which companies we can do on that channel. Okay, now as far as coming up with the valuations for many of the stocks that we analyze on this channel, and ultimately on that channel as well, I've been asked a whole bunch of questions, specifically around discounted free cash flow, why I calculate the fair value the way that I do. So generally, what I do is I take projections, usually from analyst estimates, for free cash flow, and I discount them by a required rate of return. But technically, there are two different free cash flow numbers that we should be using. First is free cash flow to the firm, and second is free cash flow to equity. And if you're curious, these are the formulas for those two. Now, this is important because if we ever learn about how to do discounted free cash flow in a textbook, well, generally what they say is that if you're going to discount free cash flow to the firm, well, you discount that by the weighted average cost of capital for that particular company. And if we use free cash flow to equity, well, we discount that by a required rate of return. Now, generally, what I do is a bit simpler, although perhaps not as technically accurate as one of these two formulas. And what I do is I take cash flow from operations and I subtract capital expenditures. That's it. That's how I come up with free cash flow. And then I discount that by a fixed discount rate or a fixed required rate of return. And then once we run that calculation, we come up with the fair value for the stock. We then adjust those numbers for net debt. So if they have more debt than they have cash, then the value of that stock, in theory, goes down. If they have more cash than they have debt, then the value rightfully goes up. Now, I do this for two primary reasons. First, most analysts that do provide projections for free cash flow, generally they're offering this type of thing. They'll project out cash flow from operations or maybe capital expenditures. Or if we use a site like Bloomberg, well, Bloomberg often calculates free cash flow the same way. And since in most cases, I'm not going out and building a full financial Excel model on a particular company to come up with projections, I found that using analyst estimates with this simplified version of free cash flow works, one, quicker, and two, it works fairly well. Now, I actually did a whole video on how to come up with discounted free cash flow, how to do the whole calculation, including projections. If you're curious how to do that, I'll leave a link to that video in the description below. But either way, at the end of the day, I do this because it is much simpler. And since we're trying to do this many, many times with a whole bunch of different companies, I find it to be much faster and much more effective to take these numbers, simplify it, and then dive deeper into the numbers if we perhaps like that company. Now, the other question I often get asked about is, why am I using a fixed required rate of return? And as I mentioned before, generally, if we're discounted with free cash flow, when we're using free cash flow, we're either going to discount by a weighted average cost of capital or a required rate of return. Generally, we can use something like a capital asset pricing model. And that's a very effective model that some people love, some people hate. Like everything in finance, there seems to be split, but it has been widely accepted for a long time. But the reason that I use a fixed rate is just to illustrate real quick. So I came up with the weighted average cost of capital for Disney stock on a quarterly basis going back the past few years. This chart sort of graphs that out where each point in time, once per quarter, where that came out at each quarter. And we can see, depending on what the stock does and what interest rates do, well, the cost of capital can swing a decent amount. And at the end of 2020, just to illustrate, well, heading into 2021, start of 2020, I came up with a cost of capital for Disney of 7.7%. And then just a couple months later, 3 months later, came up with 8.8%. This means that if we kept free cash flow estimates constant, if we kept them the same, well, this would mean a huge swing in the perception of fair value for Disney's stock. We're talking about a difference of about 25%. To me, that's a crazy adjustment to make just because a stock might get a bit more or less volatile. More or less volatile. Their beta would change, their beta changes, cost of equity changes. There's a ripple effect. So instead, I've kept my required rate of return at 7.5%. Now, if we see there's a drop in the fair value of, if our calculation drops, the fair values drops, well, we know that this is likely tied to the fact that analysts have dropped the projections for free cash flow. And to me, that's way more important than the fact that the beta of the stock moved around a bit. Now, with that being said, I really am hoping that anybody who takes my calculations for fair value for any stock considers if they should increase or decrease the required rate of return. Or perhaps they think that analyst estimates are they reasonable? We think they should be adjusted higher or lower? I hope that everybody can take what I'm doing and adjust it to best suit their portfolio. I'm just trying to lay a steady groundwork that everybody can work off of. Because at the end of the day, it's up to each of us to decide which stocks or ETFs belong in our personal investment portfolio. And I'm hoping that what this channel does and what our new Shorts channel will ultimately do is to help identify stocks that could be over or undervalued. And hopefully, at the end of the day, improve our portfolio and get us closer to achieving our goal of financial freedom. So if you can, please go check out the Disney Shorts video that we recently published over on that channel. I get a link right here. I get a link in the description below. And while you're over there, maybe you could hit the subscribe button, hit the bell icon, and let me know what companies you think we should either do a short video on over on that channel, or perhaps a longer, more in-depth video on this channel. Thanks, and I'll see you in the next video.